Welcome back. You are watching The Money Show with me, Kavita Thapliyal. One of the basic principles of financial planning is to keep your investments and insurance separate. Especially talking about insurance products that offer the option of investments should be selected or opted for carefully. Now, one of the most talked about investment product within insurance is ULIP, unit-linked insurance plans. And since May 2023, we've been witnessing the trend of equity exposure tilting towards small and mid-cap as far as the exposure in new ULIPs is concerned, or even the existing ones. There has been a surge of small cap and mid cap exposure in these kind of plans as well. But how should you, as an investor, look at it? Are these new ULIPs offering you better returns than a small cap or a mid cap fund? Let's discuss all of this. I have with me Vivek Jain, Head Investor PolicyBazaar.com, and Pankaj Mathpal, MD, Optima Money Managers. Thank you so much. Good evening to both of you and welcome to the Money Show. Vivek, I'll come to you first because we want to understand what kind of ULIPs are we talking about, okay? The modern ULIPs are said to be more investor friendly, and looking at the kind of exposure they have increased in small and mid cap, even the specific mid cap and small cap ULIPs have been launched. These insurance companies are really trying hard to not only woo investors but also trying to make the most of the trend wherein small caps and mid caps are really ruling as far as returns is concerned in the portfolio. But I also want you to answer this question taking the costing under consideration that gets involved in a ULIP plan. Okay, so keeping the costing in mind, the return that they need to churn out, having exposure in small and mid cap, how is this exposure placed for an investor?
Kavita, I think let me start off with talking a bit about the new age online ULIPs and talking a bit about their costs. See, there are four key types of costs in a ULIP plan. But in the new age ULIPs, the premium allocation charges are generally not there. The policy admin charges are also generally not there or very, very low. There is a charge of life insurance, which is the mortality charge, that in the new age ULIPs is generally returned at the time of maturity. So the life cover that you are getting in a ULIP is generally, if you see, not costing you anything because that gets returned at the time of maturity. What is then left is just a fund management charge, which is capped at 1.35% in case of an equity fund, and it ranges around 0.8, 0.9% in case of a debt fund. So coming to now new funds getting launched in the mid-cap and the small cap space in the ULIP market segment. See, I think mid-cap funds have always been there in the ULIP, in the earlier ULIPs as well. And historically, if you see, the returns are not very different from what the mutual funds have offered. The good part about investing in mid caps or small caps, given they are more volatile than a large cap investment, is the lock-in that is there in a ULIP. See, a 5-year lock-in in a ULIP kind of builds that discipline that you're investing your money in a monthly fashion every month for the 5 years. And if you're investing in long term, then mid caps and small caps are more often than not going to give you better returns. If you are looking for a short time horizon, then mid caps and small caps can be volatile and can be risky.
All right. So far as the costing is concerned, it's become a much better product as far as the older ULIPs that we talk about, Vivek, and the 5 years lock-in might just help an investor because talking about a volatile category like small cap and mid cap, that might really force them to stay invested for a very long time. But then, Pankaj, is it really fair to just look at the fact that a ULIP is offering you exposure in small and mid cap? You should just go immediately buy a ULIP plan because of this exposure. You have direct stocks, mid cap and small cap. You have mutual funds that offer you the same kind of exposure also in specific funds. It's more about an investor being disciplined in their approach when they are considering these kind of market cap categories. What will you say?
See, I'll say that primary objective of ULIP is not investment, that is insurance. So if you are considering investment, then definitely mutual fund is definitely a better choice. Returns may be almost same, though if you compare many schemes, you'll find that mutual funds, most of the mutual funds in mid-cap category are performing better than the mid-cap funds under ULIPs. But still, I'll say because benchmarks are same, so returns may be almost same, but there are many other things which you have to consider. The cost has come down, but still, if you compare in most of the plans, and including your mortality charges, the cost will be a little higher than the mutual funds. More than this, what is important, see, when you invest in mutual fund and you are not satisfied with returns, you have choice to exit from the scheme any moment. But when it comes to ULIP, there is a lock-in of 5 years. So that is the main difference here, because when you think about investment, you invest, you want liquidity as well as you want control in your hand. Though we say there is discipline when you have a lock-in of long term, but at the same time, if you need money, you will do. And if the fund is not performing, forget it, whether you invested 5 years and you need money after 2 years. But if a scheme is not performing, even then you do not have choice to exit from that. But in case of mutual funds, you can exit any moment. In addition to this, when you want to surrender your ULIP even after 5 years, it's not that fixed like mutual fund. When you want money from mutual fund on the basis of T+2, the day you submit your redemption request, in 2 days, money comes in your bank account, which is not the case with ULIPs still. It is like 7 days, 5 days, something like that they take. It depends from one insurer to another insurer, but not that fixed T+2 or in that scheme T+1. So I'll say still, for me, insurance is insurance and investment, you have other products. So ULIP is not a very good choice.
But also talk about returns and tax implementation, Vivek. How are the returns different as compared to a mutual fund product? Talking about...
Yeah,
Sure.
I'd like to add a couple of points here. One,
Okay.
in a ULIP, if you are investing up to 2.5 lakhs a year, then there is no tax, there is no LTCG or STCG. So LTCG, basically only LTCG can apply because it's a more than 5-year investment. So there is no long-term capital gain. So that is one of the big reasons why people have now become interested in ULIPs, because if you are investing in a mutual fund, the gains that you are making, 10% of that, adjusting for 1 lakh a year, will be taxable. So I'll just give a small example. Say, supposing you are investing a 10,000 rupees SIP for 20 years, right? And at a 12% compounding, you will end up making 1 crore corpus, right? Which is basically, and you have invested over 20 years, you have invested about 24 lakh. So on the 75 lakh, 76 lakhs rupees profit, in a mutual fund, you will end up paying 7.5 lakh rupees as taxes. While in a ULIP, there will be no charges because your annual premium was less than 2.5 lakhs. So this 7.5 lakhs more than offsets for the slightly higher cost that you are incurring in a ULIP plan. So I think the taxation benefit really takes care of the slight disadvantage on the cost side. So if you are investing, again, I repeat that if you're looking for a 5-year or more than 5-year horizon, then ULIPs are a very good option. Another point around that exiting a non-performing fund on the mutual fund side is easier. But in a ULIP plan, typically all the ULIP plans have about 6 to 8 equity funds and other 5 to 6 debt funds. So typically all ULIPs have, I would say, somewhere between 10 to 14 funds. And in the online version of the ULIPs, the switching from one fund to another, depending on the market condition, from debt to equity or from mid cap to a large cap to a multi cap or a flexi cap, all of that, those fund switching is free. Whereas in a mutual fund, you end up paying an exit load, and you may end up also incurring short-term capital gain charges if it is exited within 1 year. So I think more or less the new age ULIPs counter all the points that mutual funds had as an advantage.
But Pankaj, don't you think that mutual funds have really outperformed over here when we talk about small cap and mid cap as compared to a ULIP? The performance by a mutual fund has been much better.
See, if you take example, again, I said earlier also that it depends from one scheme to another scheme. But if you compare, for example, I take HDFC Midcap Fund, which had delivered around 33% return in 1 year. And if you take example of HDFC Life Click to Invest Opportunities Fund, which had delivered around 19% return. So if you say in the same like midcap only, mutual funds have delivered better returns compared to ULIPs. But still, I'll not say this is the very fair comparison because it depends on from one scheme to another scheme. But still, as I said, just now, my co-panelist was telling one point that you have choice to switch from one fund to another fund. But what? Within the same insurer, within the same insurance company. Sometime you have seen in mutual fund also, as well as in insurance also, that almost all the funds are not performing in one fund house. But in mutual fund, you have choice that you redeem your units and you invest in schemes of some other fund houses. Second thing, if you're comparing small cap to small cap or mid cap to mid cap, I do not want to redeem from the mid cap and want to go to large cap because the large cap of that same insurer is performing better. I want to go to mid cap only. So in mutual fund, I have choices. I agree with this thing that from tax point of view, definitely that up to a premium of 2.5 lakh in one financial year. So returns around that will be tax free. This is advantage on this. And also that switching from one to another, debt to equity and equity to debt will not attract any capital gain tax. But at the same time, when you talk about investment, you have to see returns, liquidity, safety, multiple things are there. So I feel that no doubt that ULIP is one product and can be considered in some cases, but in most of the cases, I think mutual is still a better choice.
Vivek, talking about the new ULIPs which are launched and which are primarily small cap and mid cap focused, could you please elaborate on the kind of exposure they have in terms of equity and market caps?
So, see, I think mid-cap funds were always there in the ULIP category. In the last 6 odd months, what we are seeing is that insurance companies have also launched small cap funds. Bajaj Allianz had launched a small cap fund in the month of May. And that, again, I think returns in the last 6 months should not be taken as a benchmark, but last 6 months, they have kind of given 25% returns. Tata AIA launched a small cap discovery fund, and Max Life came up with an interesting concept, first time in the insurance industry, where it came out with an index fund, which has small cap quality 50 index fund, which will kind of mimic the index quality 50, small cap quality 50 index. So the mid cap exposure was there in the existing ULIP funds as well. Small cap is the new flavor that has got added in this year, and 3 insurance companies have actually come out with funds in that category.
All right, so a better investment avenue when it comes to having exposure of small cap and mid cap is definitely via the route of mutual funds, if at all you are risk averse, and if you have a strategy where you can buy direct stocks, you got that plan for yourself. But then, Pankaj, if in any case one really wants to consider having a ULIP and exposure in small cap and mid cap via ULIP, what are the 3 thumb rules that you might want them to consider and incorporate those kind of ULIPs in their portfolio and maybe align them with their financial goals as well?
Kavita, I'll say one thing. First thing is that your primary objective should be insurance. Second thing, when you invest in ULIPs, it means you do not have very good knowledge of market. Because generally, if you have means you are a market savvy person, so you'll go for the direct stocks or you will invest in mutual funds. So for me, first thing, the ULIP investors, they should consider the balanced portfolio or the multi-cap portfolio instead of going for a small cap or mid cap or because there is a choice that whatever premium you are paying, you can divide it among the different market segments. So that can be done. but purely going for a purely small cap fund, and that too at this moment, because when we have seen a good rally in the small cap and mid caps, so entering at this point may be very riskier. And as I said, that because what I consider in general that insurance investors are not market savvy usually. So if they avoid small cap and mid cap and rather go for multi-cap kind of portfolios, that will be a better choice in long term. And in long term, otherwise also we have seen that all the market segments have potential to deliver good returns. It is only time means sometime large cap outperform mid cap and sometime mid cap outperform small cap. But for long term, I think that Nifty 500 benchmark can be a better choice where you have all the large cap, mid cap, small cap segments.
All right, I think that will be all for the discussion. Thank you so much, Vivek, for being on the show today. But Pankaj, we request you to stay on. It's time for a quick break, and post that we will get our viewers on the show live, and we will also answer their financial portfolio queries. But then before that, if you are someone who wants to ask their investment-related query, do send us your question on our WhatsApp number, which is 865-797-4571. What you can do is also email us your questions on the Money Show at etnow.tv, and we will get your live financial planning done on the show by our experts. See you after this break.